Thank you very much for coming. The title slide is a little bit my bio on the left, the cover of a book I just wrote, The Fiscal Theory of the Price Level. It says money is inflation is jointly a monetary and fiscal phenomenon, which I think Jim agrees with as well. The center is a little cartoon my son made for me of my persona, the Grumpy Economist, and how it started over the breakfast table, getting mad about some op-ed in the Wall Street Journal. And on the right, I just wanted to advertise, I do a podcast with Neil Ferguson and H.R. McMaster called The Goodfellows, which if you're looking for a way to waste some time is always a good way to waste some time. I'm here to talk about inflation. So what just happened? This is a graph of the inflation rate in red, plotted on the right axis, and the price level in blue, plotted on the left axis. This is produced by the best thing Jim Bullard ever did while he was president of the St. Louis Fed, at least that I know of, which is the FRED database, which allows you to go quickly make graphs like this. So not the best thing, but one of the great accomplishments of the St. Louis Fed. So what happened? Inflation was trundling along at about 2%. We hit a recession with the COVID pandemic. Inflation went down briefly, as it typically does in recessions. It started back to trundling along, and then boom, February 2021, we got this surge of inflation, peaked out about 9% about a year later, then eased off a bit, and is still, maybe we're coming in for a soft landing, maybe we're going to stall about 50 feet off the runway, maybe we're going to take off again, who knows where we're going, but there we are now. It at least it did not spiral away to Venezuelan levels, but it came back again. I plot here the price level in blue as well as the inflation rate in red. I know this will seem obvious, but this is not obvious in Washington, D.C., nor among much of the punditry that writes about inflation. These are two different concepts. The inflation rate is the year-to-year change in the price level. The price level, measured on the left, it's an index of 1982 is 100, so prices start in 2013 at 230, so 2.3 times higher than they were in 1982, and rise all the way up to now, we're about 320. So you can see the cumulative, the steady erosion in the value of the dollar, the steady rise in prices represented by the price level. I put it up, one of the big things about that you learned in an economics class is think about the levels, not just the growth rates. The levels matter. So you can see what happened in that little bit of inflation, deflation for disinflation, the price deflation actually. The price level goes down a little bit and then starts growing again. The price level shows you the cumulative effect of the inflation that we've had. Prices have gone up and stayed up. So inflation eased, the price level did not. We did not go back to the previous level of prices, which tells you a lot about the left-right divide. Paul Krugman in the New York Times says, oh, the little morons out there in the heartland, they don't understand that inflation has gone away. Inflation has gone away a bit, but the price level remains much higher than it was and much higher than people expect it to be. Stuff is more expensive than it used to be. They're not quite as dumb out in the heartland as Paul would have them believe. So those are two important facts, and just important to remember what inflation is and what the price level is. So that's what just happened, and I want to spend some of my time talking about why. What just bit us in the butt, and maybe we can talk about how it shouldn't do that again. Stuff is much more expensive than it used to be. Here is a larger history of inflation over the post-war period. I'm presuming not everybody here is an expert on it, so I thought I'd give some background. I see some undergraduate-looking faces, so that's always good. Those of you who don't remember it, how does our recent bout of inflation fit into the larger history? We had substantial inflation just after World War II and in the Korean War. So inflation does tend to get correlated with wars and crises. That's an important thing to remember. But the previous biggest episode on most people's minds is the three waves of inflation that hit in the 1970s. So that's the historical precursor and what formed that historical experience forms most of our outlook, most of our doctrine about what monetary and fiscal policy can and can't do. You can see that those three waves of inflation led to a substantial rise in the price level. And then, thanks in large part, monetary policy did help here at least, due to the courageous action of the Federal Reserve. Inflation came down, trundled back down to 2%, until boom, here we go again. So all except for the flowered shirts, the long hair, the wide ties, maybe it's the 1970s again is something I think we ought to worry about, but at least to think about that in the context of historical experience. So let's go back to, with the historical background, let's go back to the current inflation and look a little bit more closely. So again, here's the picture, and now I have added here the federal funds rate. This is the short-term interest rate that is directly controlled by the Fed, and that's the Fed's main lever of monetary policy, raising and lowering interest rates. Jim spent much of his life worrying about up or down the interest rates. That's what the Fed does. Bigger picture, we hit the COVID recession. Inflation went down. Then the Federal Reserve did what the Fed always does, set lowered interest rates, exactly what you're supposed to do if you have a big recession and lowering prices. Left interest rates at zero, exactly what the Fed had done from 2008 to about 2016. But then inflation did take off. And you can see here, the Fed didn't do anything unusual. So I might challenge Jim, if inflation's always and everywhere a monetary phenomenon, at least it's not an interest rate phenomenon, because the Fed, you can't throw a lot of brickbats at the Fed for having caused this, right? So inflation came seemingly out of nowhere and spiraled up. Unusually, the Fed did nothing about it for a year, and many of my buddies out at Hoover were jumping up and down about, why aren't you raising interest rates? Then inflation started to ease, just about coincident with the rise in interest rates. But normally, standard doctrine of monetary policy says that for the Fed to it first says that inflation will spiral away until the Fed raises interest rates above inflation and causes a big recession to push inflation down. That's standard doctrine. But not only did inflation come out of seemingly nowhere, but then inflation started to go away long before the Fed had raised interest rates to the point that real interest rates were even positive. The interest rate was above inflation, let alone causing a big recession, which did not happen. People have been forecasting a recession next quarter for the last 4 or 5 years, and it just never seems to happen. So inflation kind of went away on its own, and then here we are. I didn't make the graph, update the graph, but the Fed funds rate has just gone back down again. The Fed thinks we're on our way. So where did this inflation come from? Why did it plateau and then ease? Why did it not spiral upward as long as interest rates were below inflation? Why has there been no recession? So where did it come from? Why did it go away? And what happens next? Seems like the obvious questions to ask of this historical episode. So where did inflation come from? Now, of course, here I am going to advertise my pet theory. You don't bring an economist all the way from California unless he wants to advertise his pet theory. But I think it's a good one. So what else happened? I added here in the black line, so we still have inflation, the interest rate, and now we have as an indicator of fiscal policy, debt, total federal debt. So what our government did in the pandemic and afterwards was borrowed $2 trillion of money, printed up almost literally $3 more trillion of money. Actually, the Fed, the Treasury issued another $3 trillion of debt, and the Fed bought it almost instantly and gave reserves money in exchange. So essentially, the government printed up $3 trillion, borrowed $2 trillion, and wrote people checks. So back to the dictum, always and everywhere a monetary phenomenon. Certainly, there is some smell of that. What happens when you print up $5 trillion of money and you write people and businesses checks? They go out and try to spend it, and boom, you get inflation. And that's the essence of the theory that I'm going to spend another 45 minutes. So if you fall asleep, that's fine. You won't have missed a whole lot. Now, I do not want to sound critical. The pandemic was a genuine crisis. It genuinely threatened to shut down large parts of the economy. Borrowing, especially borrowing and maybe even printing some money and helping people out is something the government should have done. I think it kind of overdid it and could have spent it a lot more wisely, but that's not important. Zero was not the right answer. And I'm not here to criticize what it did, but simply to analyze the effects of what it did. So when people have, when total debt goes up 30%, people have $5 trillion in their pockets, they start spending it. And that sends inflation up. I put the cover of my book here just because I am, in many ways, the luckiest economist on the planet. In February 2021, I also sent to the publisher a draft of a book I had been writing about inflation, and I had been working on this book for literally 30 years. Finally got around to finishing the book, sending it in. Now with inflation that was at just below 2%, my first draft of the introduction of the book said, we haven't seen inflation since the Reagan era. You're going to sell 3 copies of this book, but put it in a library somewhere. Someday dust it off. You may find it useful. By the way, don't print up $5 trillion and hand it out. That'll cause a lot of inflation. So fortunately, I got a chance to rewrite the introduction along the way to printing. So that certainly seems like a first order obvious case of what caused the inflation to break out. Now, it's not so easy, and there's a reason this is not a 300-word op-ed, but 630 pages worth of dense equations. All things in economics have to be worked out a little bit more carefully, and that is true of the fiscal theory of the price level as well as other things. So let me give you a little introduction to how I think of inflation. What is the fiscal theory of the price level? It is the proposition that the central thing that determines the price level, central thing that pushes inflation, is that the real value of government debt, that is the face value divided by the price level to turn it into something real, has to equal the present value of primary government surpluses. The government issues debt and money, and it soaks up, if there's too much debt and money out there, it soaks up that debt and money by raising taxes above spending. So taxes greater than spending soaks up debt and money. Taxes less than spending issues debt and money. And if we have too much of it, we try to spend it. So that's good. That's how the government stabilizes the price level. I learned only a very few things in life, and I am like the 2-year-old with the hammer to which everything looks like a nail. And that's true here as well. This is just the theory of asset pricing applied to the government. So if you understand why stock price is present value of dividends, you understand this theory perfectly. If you, stockholders, see that the dividends aren't going to be there, you try to sell the stock. We can't all sell the stock. Someone's got to buy it. And so that just drives down the stock price. If we as investors and citizens see that the government, when we give up hope that they're ever going to pay this stuff back, we understand it's got to end badly. What do? We try to get rid of government bonds. Now, I can sell it to you, you can sell it to your neighbor, but collectively, someone's got to hold it. If we're all trying to sell, the only thing we can do is try to turn government bonds into goods and services. That drives up the price of the goods and services. Exactly the same mechanism as stock prices. Now that insight, very simple insight, but that tells you something very important, and it puts limits on this theory's ability to understand inflation. Because as price is present value of dividends, now many, I come from Silicon Valley, where there are companies with very high stock prices and very negative earnings. How does that make any sense that they're losing money hand over fist and they're worth $100 billion? Well, everybody expects that in the future, in the long run, the spaceships to Mars are going to make a lot of money or something of the sort, or whatever the promise is. What that tells you immediately is that debt and deficits do not cause inflation by themselves. Debt and deficits cause inflation when they are not sufficiently backed by people's expectation that they will get repaid over time. In fact, government debt is a great, good, and wonderful thing. Why is that? Here is a graph of how well-run and well-managed government debt works, which is usually how our country works. A country can borrow a lot of money in time of crisis, a recession, a war, a pandemic, and then promise to pay it off in the future. Just as you might borrow a lot of money to buy a house, and then you promise to pay it off in the future. If that happens, if we get a shock like that, the change in the present value of surpluses, the negative matches the positive, there is no effect on inflation. So that's good, normal, everyday fiscal policy of the type we normally do. Borrow in bad times. People credibly believe it'll get paid back in good times. There's no change on the right-hand side, and therefore no needed change on the left-hand side. Or if you will, the increase in nominal debt is entirely matched by the increase in present value of surpluses, no change in inflation. So it is not a theory that says debt and deficit's bad. It's debt and deficits that people don't expect to be repaid. That makes it harder, but welcome to asset pricing. What is the expected dividends justifying Tesla's valuation? I don't know, but that's our theory, and we run with it as best we can. So that's good policy. The danger is, of course, not so good policy. What happens if there is a debt or deficit and people do not expect that it will be repaid? That is what causes inflation. So it's not the left part, it's the right part that matters. And so we have to think about that when we want to understand historical episodes. Of course, the other danger is there can be no debt or deficit today and people lose faith in the future. Then inflation breaks out seemingly out of nowhere. So it's lovely to have a theory that says things can break out and nobody sees why, because you can explain a lot with a theory like that. Welcome to asset pricing. But this happens all the time. Greece, for example, had a debt crisis, not because it was funding a big deficit that day, but because everybody lost faith in the fact that it could repay it in the future. That's how debt crises often come out. So those are our possibilities. It's a little more subtle than just, when I said print it up, borrowed $5 trillion, handed it out, it's more subtle than that. It involves, did people look at that money, that debt, and say, oh, this is a great savings vehicle. They're going to pay this stuff off, I'll hang on to it. Or did they look at the stuff and say, there's no plan to pay this off, I think I better try to get rid of it back so the debt goes down to the value that the government can actually repay. That central decision, do I try to spend it or do I try to save it? Collectively, sort of by definition, we decided that extra debt was something we'd try to spend, not something to save. And that's what causes inflation. So with that in mind, let's look again at the historical episode. So it's not as easy, right? At least to tell a story. And so I'm not going to offer you proof. I'm going to offer you possibility. But possibility is the first step of proof. Is it at all plausible that this could be a story for what happened? Proof requires, can I prove this is it? And can I prove all the other stories are false? We're not going to get there. But at least if you can say, hey, there's a plausible, simple story, we've made some progress. So we have to think about, why did this deficit cause inflation? And other deficits, like 2008, did not cause inflation. What is there, is there a plausible story looking at what we all know? I see some of us remember 2008, and some of us are blessedly too young to remember 2008, but what was there different about that time? Well, there was a lot different. So in the big stimulus of 2008, the government did the same thing. Interest rates to zero, borrow a lot of money, hand out checks. That's what you do in a recession. But at least in 2008, the politicians made promises. They said deficits today, but debt repayment later. Now, I'll admit to having been kind of a grumpy economist and saying, ha, 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 that debt repayment always seems to come on the first day, 8 years and 1 day after your inauguration. Yeah, right. But at least they had the decency to promise it and to put down some plans that they were doing it. There's a good case that people expect, as throughout, you saw we had lots of debt and deficits previously in the US, and typically the US borrows in bad times and then goes back to surpluses in good times. That is the standard way of doing things. This one was different, and I don't want to go too deep into the history here. You can read the papers if you want to. But it was different. There was no talk of repayment with the stimulus of the COVID years. Congress used to have spending rules that there were pay-fors. You couldn't spend more without saying where the taxes came from. They suspended the pay rules. The talk, especially around January 2021, was about, Janet Yellen said, go big, interest rates are low, don't worry about repaying debt. Modern monetary theory, R less than G, that was, those of you who know what that is, that was the zeitgeist in economics. Government debt doesn't matter. All those worrywarts about government debt, that was very much in the zeitgeist. And in fact, I think what happened in February 2021 is the pandemic was over, the recession was over, and yet they passed $1 trillion spending bills. So I think if you were still sitting around saying, is this government going to pay back debt, or are we going to just layer spending on top of spending? Those are events that really suggest, no, we're going into perpetual deficits. So again, that's, for one reason or another, Americans did not view that debt as something to hold on to and save. They viewed it as something to spend. And that's the fact, and that's what the theory says is the central fact. Hard to look into people's heads, but it's not inconceivable that that was a reasonable expectation. Now, I want to show you, I've told a story. I want to show you a model. There's some equations over there. I grayed them out for a reason, because I don't want you, if you know there's equations, you say, oh, yada, yada, yada. If you don't, you won't. But there are equations. And I say that as a point for those of you who are not professional economists. This is how we think. We write mathematical models. We don't just tell stories. Now, there's a reason, one might say that's where we lie, cheat, steal, and hide all the implicit assumptions. But it's quite the opposite. If you write a mathematical model, that does not prove you are right. But if you cannot write a mathematical model, that almost certainly proves you are wrong. I'm talking to you, modern monetary theorists. The writing of a mathematical model forces you to make assumptions explicit, and often very painful assumptions. This model, by the way, is quite wrong when you look at it, but by writing it down, the difference between inflation today and inflation yesterday can get kind of messy. When you write down a model, it's very easy in discussion to forget about budget constraints. The one thing that is absolutely true in economics is a budget constraint. If I spend more on X, I got to spend less on Y. If I import some good, then dollars go the other way, and either I got to export something, or they have to buy some assets in the U.S. The capital account and the current account add up. These are things that popular discussion completely forgets, and especially political discussion. I'm going to give Jim money from the federal deficit, from the federal government. Yeah, where does that come from? So you got to write down where the taxes are in the model. So writing a model is a very important discipline. And I wanted to emphasize that's what I do, and that's what the 630 pages are about. That's why it's important, at least as discipline, to say this could be right. So anyway, the model I wrote down puts in ingredients beyond the story I just told. And the first ingredient is that prices are a little bit sticky. So those of you who do, you'll recognize the Mike Woodford two equations of the standard New Keynesian model. Second, I assume here exactly what I told. What if we do a deficit that people do not think is going to be repaid, and just crank out what the model says will happen? So it's a quantity. I call them quantitative parables, and that's what we do. They're not truth. They're very simplified versions of reality. They are quantitative parables. So what's the result of this? So here I ask this system of equations, what happens if you drop, in this case, 1% of GDP of money or debt on people with no plan to pay it back? And at the same time, the Federal Reserve does nothing. That's the interest rate here is a constant, meaning what happens if the Fed does nothing in response. And you could see what happens. What happens is you get a burst of inflation. Pi is the inflation rate. Measuring inflation as year-on-year differences, the way we do, you can see it, the instantaneous inflation jumps, but it takes a full year before you see that effect in the year-on-year differences. The price level grows slowly and eventually jumps up, and then inflation goes away. Why? I gave you once a bunch of money without a plan to pay it back. You go out and try to spend that money, raising the price level, until the value of debt is back to what, the real value of debt is back to what we think the government can repay. And then there's no need for the price level to go up anymore. So you get a burst of inflation that goes away because you get a one-time burst of the price level. So that's what a formal model says. And you can see, boy, what happened? That's what happened in real life. What does a very simple model say? Says like that, these things, it doesn't prove that the model is right, but at least this very simple way of talking about it is consistent with what we just saw. Here's another piece of evidence that just came out in a lovely paper by Bob Barrow and Francesco Bianchi. They looked across countries, and they lined countries up by how much government spending. Excess doesn't mean a moral sense of excess. It's more than usual. So how much unusual spending did the government do, divided relative to the initial debt over the pandemic, and the change in the total rise in the price level during that period. And you can see where's the U.S. There's the U.S. up in the middle there. And you can see countries varied. Some countries did more of this stimulus, some countries did less of it, and the total inflation lines up pretty nicely. So it's confirmatory evidence that this fiscal policy caused the inflation. That's kind of a nice one. Now, what about the Fed? Poor Jim here. Sorry, I'm going to be picking on you all day, Jim. Does the Fed not matter at all? What I've done, the Fed did eventually, the cavalry did come, maybe a little too late for some, but the Fed did raise interest rates. What effect does that have? It almost seems like we got a story where inflation comes and goes away on its own. And the theory says, yeah, inflation would have gone away on its own very slowly if the Fed had done nothing, because we're kind of waiting. But the Fed did something, and what effect could the Fed or did the Fed have when it did it? So here's the same model. It's spiffed up a little bit with some ingredients. It's got long-term debt in it, which matters. And it asks the question, what happens if the Fed raises the interest rate? And in this case, there is no change in fiscal policy. So if there was this fiscal shock, we add this to the graph you just showed, or it's just what can the Fed do all by itself without any help from fiscal policy? So what happens? What happens is raising interest rates lowers inflation. That's kind of nice, because that's kind of the standard belief we all carry around, that the Fed, by raising interest rates, can lower inflation. And it's the fiscal theory of the price level, but that doesn't mean the Fed is unimportant. The Fed's very important. The Fed, by raising interest rates, can have a big effect on inflation. But the Fed can't, there's this fact, we gave out $5 trillion of money without a plan for paying for it. If we're not going to pay for it, and it came out of, someone's got to pay for it, and the answer is it's got to inflate away the existing debt. It comes out of the bondholders. So you can see I lowered inflation right away, but I raised inflation over the medium run here. So what the Fed does here, the Fed cannot eliminate the inflation caused by a fiscal blowout, but the Fed can choose to have it come later rather than sooner, basically by having it fall on long-term bondholders rather than short-term bondholders. So I call that unpleasant interest rate arithmetic after a lovely paper by Tom Sargent a long time ago. The Fed cannot make inflation go down and stay down, but in the long run, in the very long run it can, but in response to the fiscal shock, there's got to be some inflation. What it can do is move it over time. And that is a great and good thing for the Fed to do. So in all of our models, steady inflation doesn't really cause that much trouble. It's inflation shocks, it's movements of inflation that cause a lot of trouble. If the Fed, if the fiscal policy does this, it would be a very good idea for the Fed to respond that way, because then you would get just a low, smooth inflation rather than this sharp change in inflation, which is bad. The joke version is the Taylor rule is always the answer. It's just the questions that keep changing, and that actually is great praise for the Taylor rule. So putting this together, this is what we do. Here's the fact in interpreting episodes. Here's theory. In terms of theory, I gave you two conceptual experiments in an extremely simple, two equations of economics model. What happens if there's a fiscal blowout and the Fed does nothing? You get inflation that comes and goes away on its own. What happens if the Fed raises interest rates? That lowers current inflation at the expense of medium-term inflation. There's the facts, and I think I see, now squint a little bit. That's what happened. The fiscal blowout, of course, was staggered over time. This is a boom, one-time fiscal blowout. So the amount of money that was sent out was staggered over time. The realization it might not get paid back was staggered over time. So that kind of draws things out a little bit. The Fed came later, so I think what this says is, yes, the Fed helped bring down inflation more quickly than it would have, at perhaps the cost of medium-term inflation that isn't going away as quickly as we might think. And that also seems to be roughly where we are. In any case, I've given you an insight. Those of you who don't do it, this is how you do historical analysis and how we try. There's a lot of formal model testing in economics, but how we try to match facts and theories and at least say, does the theory get up and walk? Is there a plausible story? And then we can try testing it versus other stories. Other stories. So let's think about what other stories where it happened. Of course, in politics and commentariat, we have monopolies came and raised prices. Greed. There was a sudden outbreak of corporate greed in exactly February 2021 that then went away. Why they weren't greedy before, I don't know. Price gouging. Yes, it's all because they engaged in price gouging. A little more reasonably, supply shocks. There was a pandemic. It was hard to get business done. You couldn't get stuff through the ports, imports. So what about supply shocks? That those things make things more expensive, don't they? If you can't get TVs through the ports, or you can't get chips to make the TVs, the price of TVs got to go up. Isn't that inflation? That seems very reasonable. In fact, so not only politicians, but way too many people writing about these things get this confused. All of these stories, including the supply shocks, are stories about relative prices, not the overall price level. And this is another, stop, take a breath, wake up. If you learn nothing from here, distinguishing relative prices from the price level is very important to understanding what is inflation. If you can't get enough TVs through the ports, the price of TVs has to go up relative to, say, wages. Why? Because we can't all get a TV today, right? So we got to, in some sense, be poorer. The TV's got to go up relative to wages and relative to restaurant dinners. Right? Price of TVs goes up. That doesn't make restaurant dinners more expensive. So relative prices have to tell us, go out to dinner and don't buy a TV. But that doesn't say, why should both of them go up? Or why couldn't the wages go down and the prices of TVs stay the same? The overall price level is the average of all prices. Stories about why one price should be higher than another. I'm a monopolist. I raised my price to get more profit. Well, that could be I raised my price, but it could be all the others go down. It's a relative price story, not a price level story. Inflation is about the price level. Inflation has nothing to do with prices. Only an economist could say something so outrageous, right? But that's right. Inflation is not about relative prices. Inflation is about one price only, the value of money. Unfortunately, the value of money is always one because we quote dollars in terms of dollars. So the price level is our way of understanding the value of money. So don't think about relative prices. Think about the price level. Now, once you've thought that, why was it the case that the TVs got more expensive and it was the TVs that went up and not the wages that went down? Answer, because the Federal Reserve, in its wisdom, and the Treasury, in its wisdom, saw this relative price change and understood that this wouldn't be as bad for the economy as that. Deflation hurts more than inflation. So they gave us the money with which to all pay for TVs. But we, of course, can't all have a TV. So that means the price of everything goes up. If you look, and this is true in formal models, a supply shock in a formal model only causes overall inflation when the Fed and or Treasury accommodate that supply shock and give us the money that we need to pay higher prices for everything. Supply shocks only induce inflation if they induce monetary and fiscal policies to produce that inflation. If they don't, then you get deflation. So inflation is always and everywhere a joint monetary fiscal phenomenon. It has nothing to do with prices. It has nothing to do with these relative price stories. What about money? So I'll talk about just one alternative theory because you may have heard of this one, and I kind of like Milton Friedman. He's on the left with his theory that inflation is about the quantity of money, not the quantity of deficits. And there's Milton. He had a California license plate, MV equals PY. I longed to put the present value relationship on my license plate, but I can't figure out within the limits of the letters on California license plates how to do it. And of course, the most famous thing Milton Friedman said is a helicopter drop of money will cause inflation. Drop money from helicopters, you'll get inflation. We agree, because dropping money from helicopters is dropping a form of government debt from helicopters. And helicopters are a brilliant way of saying, we're dropping money on you and we're not planning to raise taxes to pay that money back. You know, if the government had dropped money from helicopters and said with a bullhorn, by the way, taxes are going up tomorrow, people might hold on to that money to pay the taxes and it wouldn't cause inflation. So really, and most of the evidence for monetarism is about the question, is about governments printing money to finance deficits, and we entirely agree what that does. The central, if you still think money matters, the central experiment is this one. Monetarists say dropping money on you causes inflation. But what about a different thing? Suppose the Fed gives you money and takes back the same amount in treasury bills. Okay? First, I just give you money. We know that causes inflation. Instead, I give you money and I take back the same amount in treasury bills. So you know you don't feel wealthier at all. You just have more money and less interest-paying reserves, less in an account that holds treasury bills. Does that make you run out and spend? So monetarists are very clear. Absolutely yes. If I give you money versus if I give you money and take back the same amount of treasury bills, that has exactly the same effect, because inflation is always and everywhere only a phenomenon of money. I hope I've made you feel a little uncomfortable. Wait, if you give me $1 trillion and take back $1 trillion of a different kind of government debt, isn't that like I gave you two fives and a 10 and I took back your 20s? Why should that make me go spend more? Well, exactly. That's what fiscal theory says. So that's the central distinction. And they just ran this experiment for us. In COVID, they gave us money and we caused inflation. In quantitative easing, the Fed did exactly the monetarist thing. It gave us $4 trillion of money and took back $4 trillion of treasury bills. And what did that do to inflation? Absolutely nothing. So it's kind of funny. Economists tend to get lost in structural maximum likelihood estimates and vector autoregressions and so forth. There's an elephant sitting in the room screaming at us that we just got thanks to, Adam Smith up on his clouds said, here's an experiment. Let's tell apart monetarism from the fiscal theory. I will first give you money and take back treasury bills. You can see how much inflation that causes. Then I will just give you some money and we'll see how much inflation that causes. And monetarism says exactly the same. Fiscal theory says one works, the other doesn't. And that's kind of, that's at least some evidence in the direction of proof. Other approaches to inflation. So what else could you do to inflation rather than fix these issues? Inflation has always and everywhere accompanied and been responded to by governments with price controls, subsidies. I will give you, the price of stuff goes up, I will give you more money so that you can afford the new higher stuff, and witch hunts against hoarders and price gougers and all the rest of them. I put up here the Emperor Diocletian in about 300 AD faced a big inflation. There's Diocletian on one of his coins. That was actually one of his good coins, the gold coins. But his problem was that he was running out of cash. And if you were a Roman emperor and you didn't pay the soldiers, you didn't have a very long life expectancy. So what did he do to pay the soldiers? They had the smaller Roman coin, the solidus, and he devalued it. He put less precious metal in it and more unprecious metal and printed up a lot of coins and gave them to the soldiers. The soldiers were very happy about this, and what happened? This is always and everywhere a monetary and fiscal phenomenon. He was printing money to finance a government budget deficit. He got big inflation. What did he do about it? He put up a level of price control. So this is a fragment of Diocletian's price controls. It's great fun to look up because it has thousands of items and prescribes the exact price for an amphora of second quality wine and a wagon wheel and including wage controls as well. And the Romans knew how to enforce price controls. So you want to know about the threatened punishments for violating these price controls. And they also understood hoarding. So the punishment for not selling goods at the official price, I don't even want to mention in polite company what the Romans would threaten to do to you. Of course, it did no good at all. People ignored the price controls, and inflation went on anyway. Except it started the decline of the Roman Empire because, of course, it screws up an economy to have price controls. Among other things, if you had a ship full of wine and you were thinking of transporting it from, I don't know, Rome to Dalmatia or something of the sort, if you knew you couldn't sell it for a decent price when you got there, you didn't bother to get on the ship. And so it started the economic fragmentation of the Roman Empire. So price controls are always a terrible idea. Now let me, back from theory, let me look a little bit at some other historical episodes and try to give you, I'm trying to give you a sense of what is this joint fiscal monetary. It is joint fiscal and money. It's really about how does the government soak up money when there's too much money out there. And the main way to do it is through taxes, or if you're soaking up money by issuing bonds, you have to promise future taxes to make those bonds worth something. So it's a joint fiscal and monetary view of where inflation comes from. And of course, it's an uphill climb because we have so much always and everywhere a monetary phenomenon, the deep influence of Milton Friedman, and the stories that have been told about historical episodes. So part of my job is there at least a plausible story about historical episodes that emphasizes fiscal theory, the total amount of debt, rather than monetary theory, one debt versus another. And I should interject and say, by the way, even Milton Friedman, we forget. We say money's always in every, inflation's always in every monetary phenomenon. This was radical in 1968 when Milton Friedman propounded it. Throughout the 1940s, 1950s, and early 1960s, the 99% consensus of academic and policy view in the United States was that inflation had nothing at all to do with money and nothing at all to do with the Federal Reserve. Inflation was about the wage price spiral and unions and negotiating and administered prices and so forth. And the Fed was just out there to do something about banks. So the idea that the Fed had any power at all to control inflation is Milton Friedman's innovation. It's not as old as you think. Anyway, end of parenthesis. I want to put up the 1970s and 1980s because this is the main episode that underlies the standard stories we are told about inflation. So let's go back and review the 1970s and the 1980s. I realize with horror, I was a grad student in the 1980s, and I remember my professors going on and about the Great Depression. And my attitude was, grapes of wrath, Roosevelt. I've seen all that stuff. Could we get on to something? So, of course, I was teaching inflation, and I recognized, oh my gosh, to these graduate students, the 1970s are as old and irrelevant history as the Great Depression was to me. My gosh, I've gotten old. But economics trundles on the same since Diocletian. So the lessons of history are extremely important, and we really don't have a good theory of inflation, but what we have is memories of this episode and our historical interpretation of it. So what happened in the 1970s? Here I added, you've seen in blue here, I changed the colors by mistake. In blue here I've got inflation, so the three waves of inflation. In red is what the Federal Reserve did. And just by history, so inflation broke out in 1972 and 1975, the first two waves of inflation. Notice the Fed raised interest rates promptly all three times. So the criticism of the Fed is that it should have done even more. But when I was a little bit critical of the Fed's response for being late this time, even in the awful 1970s, they never waited a whole year on supply shocks and stuff like that. So that was unusual this time. Like the current time, notice, by the way, inflation coming down without particularly high interest rates. So that's not unusual either, despite the standard doctrine that says you need high interest rates. And of course, my worry, look at 1975, a big bout of inflation. It comes down, trundles along, everybody's talking about soft landing, and then boom. Now, this is not a forecast, but it is a possibility, and we could be right there if we're not careful. But then the big story of inflation in the 1970s is it got really bad in early 1980. Jimmy Carter appointed Paul Volcker, and then he raised interest rates like crazy, caused a big recession, backed off a little bit, then raised interest rates 20%. Look at the left-hand side if you can see it from where you are. raised interest rates. Real interest rates are the red line minus the blue line. A decade of unprecedented, extremely high real interest rates finally beat the crap out of inflation, and inflation slowly went down. And that's the standard story we tell, and it's all due to the great perseverance of the Federal Reserve under Volcker, and therefore the Fed got its credibility, which kept inflation low. So that's the standard story. And a lot of that standard story is true, but not all of it. What about the fiscal side? What else happened in the 1970s and 1980s? Here I graph the primary surplus, that means the government's making money, versus deficit, the government's losing money over the same time period. So you can see fiscal events in the 1970s and 1980s. So the 1970s, oh wait, there's some pretty big budget deficits, aren't there? In fact, 1975 was the biggest deficit seen since World War II. And there was a growth slowdown, there was malaise, there was, we've got a debt problems brewing. Sort of the general sense of things are heading into trouble was there in the 1970s. It wasn't entirely a monetary mistake by the Fed, which is awfully hard to see here. In fact, inflation, everybody agrees inflation got going under Johnson when he wanted to fund the Vietnam War and the Great Society, and he didn't want to raise taxes. And so he's running budget deficits. We lost the gold standard in Bretton Woods because the US started inflating clearly from fiscal reasons. How about the 1980s? How did the US bring inflation down in the 1980s? Well, yes, there was tough monetary policy, but other stuff was going on too. In the early 1980s, there was a realization Social Security is about to run out of money. Does that sound reasonable? Anyone heard that before? Yes, that happens regularly every 30 years or so. Back in the 1980s, though, politics may have been polarized, but not as bad as now. Reagan sat down with Tip O'Neill, they hammered out a deal, and they put Social Security on a sustainable path for the next 30, 40 years. Now, when you're thinking about long-term future deficits, not just today's deficit, long-term future deficits, solving Social Security for a generation, that's really important. The other thing that happened, we had a tax reform. So we're talking about fiddling around with tax rates. Corporate rates to 23 to 28, I don't know. 1986, they cut the top personal marginal rate from 70% to 28%. That's big. And they got rid of all the deductions and exclusions and so forth. So that together with deregulation, started under Carter, by the way, as well as Reagan, it's a bipartisan success, the economy started booming, and look what happened to the federal budget surplus. So in fact, the government was making money like crazy by the 1990s. And because, notice, there's a fiscal side to this monetary contraction. High real interest rates are high interest costs on the debt. Who paid for that? If you bought bonds at 15% interest rates, and then they got paid off when inflation went down to 5%, you made a tremendous amount of money. Who paid that windfall to bondholders? Answer, taxpayers did. 1980s was a joint fiscal, monetary, and microeconomic growth-oriented reform, and that did the trick. Many, many countries have tried to do just that without solving the fiscal problem, like Argentina, which does this over and over again, Brazil, which does this over and over again. And what happens is you get a third wave of inflation. So you have to do all three, and the 1980s did all three. How many historical episodes can I show you? Oh, I'm going to show you this one. So 1933, there's a lovely story here. This is from a great paper by Jacobson, Leeper, and Preston. So the Great Depression is always and everywhere on the minds of economists, as it should be. One feature of the Great Depression was a massive deflation. So this is the price level, and these are three different measures of inflation, and you can see they go from 100 down to 65. In the last 10 or 20 years, we've been talking about 1 or 2% deflation as being horrible things. Here we're looking at 30, 40, 50% deflation, the price level cut in half. This is serious stuff. No wonder it was a Great Depression. And that was going and going and going until, boom, what happened right here? Roosevelt was elected, and he got rid of the gold standard pretty much overnight. So the gold standard, and the minute he got off the gold standard, boom, price level recovered. So what's the story going on here? Now, the gold standard, you have to understand as primarily a fiscal commitment not a monetary commitment. Now, it sounds monetary. The gold standard says, bring me $1 and I'll give you a 32nd of an ounce of gold. So that ties the dollar to gold. And you think, well, that's just about money. That has nothing to do with fiscal policy. But wait a minute, the government never has the gold. It's a promise, I'll give you gold for your dollars, but there's always more dollars outstanding than we got gold in Fort Knox. So how does that square up? Well, it is a commitment that should people ever come and want their gold, we will do what it takes to get the gold. And the way you get the gold is raise taxes or borrow it against future taxes. But somehow or other, a gold standard is a commitment that we will always raise taxes as necessary to get the gold we need to back the currency should the event come. So it's a commitment not to run big budget deficits, because bondholders know we can always get it back in gold, so long as they don't default, which is another issue. So the gold standard is a great way of saying we will not inflate. The Achilles heel of the gold standard is, what if deflation happens? What if dollars and gold, it ties dollars to gold beautifully, but what if dollars and gold become much more valuable relative to everything else? Well, now we have to raise the taxes on everything else to get the gold to pay this windfall to bondholders. So it forces you, when there's deflation, to raise taxes sufficiently by the fiscal theory to validate that deflation. Deflation is completely uncontrolled under the gold standard. That's what happened. That's why getting rid of the gold standard was a good idea, and that's why, bingo, it got getting rid of the gold standard stopped deflation in its tracks. Here's another great fiscal monetary story. So you want inflation? I give you inflation. This is from a paper by Tom Sargent. This is Germany after World War I. Notice the left-hand side here. It's important to always read the units. It's a log scale, 10 to the 3, 10 to the 6, 10 to the 9th. This is not an astrophysics talk. This is an economics talk, right? So when you need exponents, when you a 10 to the 14th rise in the price level, we're talking about some pretty serious inflation, aren't we? So that's what happened in Germany. And then, bingo, it ended on a dime. So what happened? Germany was, no surprise, printing money to finance fiscal deficits. One of the biggest sources, it had some internal problems. It had it was running deficits. Basically, it was very unstable politically, so handing out money to various constituencies to keep them happy. Where have I heard that before? But it was also, under the Treaty of Versailles, it was forced to pay enormous reparations to the Allies. From what? The Allies forgot about the budget constraint. Where are they going to get all the money to pay us? And there was nowhere to get it from, so they printed it up. So that's basically where the inflation is coming. What happened was a fiscal reform. So they renegotiated Versailles with the Allies to make reparations more payable. And they also instituted fundamental, not a little bit of accounting gimmicks and this is on this year's budget and that year's, but fundamental long-term structural fiscal reforms, like firing half of the railway workers. I mean, that kind of stuff, which is politically unpleasant, but once they're fired, you're not going to pay them in the future. So they stopped the long-term structural deficits. Inflation stopped on a dime. They did not raise interest rates. Interest rates went down, not up. Why? Because when you have 10 to the 10th inflation per year, interest rates are also 10 to the 10th. Once you know the inflation's over, the interest rates collapse. No period of high interest rates. No period of low money growth. Money growth exploded. Because under hyperinflation, people only hold a day's worth of money. They grab the money, run to the store, get rid of the money. Once inflation's over, people are willing to hold a lot more money. The German government got to print lots and lots of money. There was no recession. There was, in fact, an economic boom, because you get rid of the hyperinflation and the economy booms. So no tight money, no high interest rates, no recession. Boom, inflation ends on a dime. Why? Because you solve the underlying fiscal problem. Now, we're not 10 to the 10th, but it's in the extremes that you see fundamental mechanisms most clearly. So I want to close with a little bit on the future. We've done the past. How does the future look? If I've convinced you that this is at least partially an important way of thinking about the past. I have on the top right here, the top here, the Congressional Budget Office's projections about our debt to GDP ratio in purple. And you can see we are now where we were at the end of World War II. If you're in a worried mood, you say we are going into World War III with more debt than we exited World War II. That's not probably a good thing. I hope we're not heading to World War III, but and then the debt just keeps exploding. The reason the debt keeps exploding is primarily deficits, primarily driven by entitlements. We have a European entitlement state, and we don't yet have European taxes. So we've made promise to old folks that we cannot keep. That's primarily it. There's a lot of money down rat holes, but anyway, there's the structural deficits, there's the projections of debt. This will not happen. This is not a forecast. It's not a conditional mean. It is a projection based on current law and other calculations. It's a projection of what might happen if we don't fix it until it falls apart, because it must fall apart. This is unsustainable. What is unsustainable will not happen. The only question is, how will it not happen? And a bout of big inflation is one of the possibilities there. It is in fact an optimistic forecast. Why? In that ski slope, in that inverted ski slope, is the assumption that nothing bad ever happens again. Because back in 2003, they were making the same projection of a gentle rise, and then boom, financial crisis, boom, COVID. It only went down because we inflated it away. It didn't go down because we started paying it off. So clearly, I hope nothing bad ever happens again, but if it does, we seem to have once in a century flood every 10 years now, then we'll need to borrow again. So that's more likely about what will happen. Of course, that's even more unsustainable. This doesn't look very encouraging, does it? And it isn't. Now, my big worry about this is not so much, the standard worry is, oh, sooner or later a debt crisis will happen. And I will admit to being one of those people out there with the sign saying the world is about to end for about the last 25 years, saying the debt crisis will break out any day. I've been wrong for 25 years in a row. But I don't think actually that's the worry. The worry is what happens in the next crisis. Let us say China blockades Taiwan. I'll give you a gentle crisis, not the big one. China blockades Taiwan. Pacific trade falls to pieces. A shooting war may break out. It's a financial and economic crisis bigger than any we have seen. Even the great financial crisis would not be as bad as all Pacific trade stopping. Who knows who has lent how much money to who that they can't pay back in this event? Financial system falls apart. What will Uncle Sam do? We know the playbook. Print money, borrow money, throw it out. We're going to bail out the financial system, stimulus, and this time, maybe the military is going to need some stuff too, because if we get in a war with China, we're going to run out of missiles in about a week. So, definite spending. But so Uncle Sam goes to the bond markets and says, okay, I need $10 trillion stat of new savings. And the bond market just got a 15% haircut out of inflation. Are they really going to deliver $10 trillion and not have that inflated away immediately? Is somebody going to hold $10 trillion with the faith that the U.S. will pay that back? I worry no. And that's where, that's a real danger. Not only do you inflate away a lot of the debt, but the U.S. runs out of its ability to borrow money to counter the crisis. So a bailout that does not come is probably the worst possibility. So that's kind of the scary thing that keeps me up at night. Of course, the Fed's job is to raise interest rates. But if you raise interest rates, that raises the interest cost on the debt. That requires fiscal tightening. So that's going to make the Fed's job that much harder to have this debt headwind. Now, why hasn't this happened yet? Why are long-term bond prices so high? I think the bond markets, they believe this is a serious country, and America will do the right thing after it's tried everything else, just as we always do. And it would be entirely a self-inflicted wound. We don't have any external pressures. We're growing better than any country on the planet. We're growing better from a high level. We're growing better than any advanced country. There's all sorts of great stuff happening. Are we really going to have a debt crisis just because we can't get around the negotiations to fix it? So I think that's why it hasn't happened yet. But it could. Our problem is not baked in inflation. Our problem is fragility. The solution, of course, is growth. Now, this would normally lead to a very bleak, raise taxes, oh, you'll kill the economy, cut spending, throw grandma from the train, and you can see where the partisan debate goes. How can we reprogram the simulation? And the answer is growth. Here I want to remind you that, so I've got the surplus and deficit with unemployment just as a reminder. The number one thing that contributes to government finances is a healthy economy. If the GDP grows, tax revenue grows at the same tax rate. What matters to paying off the debt is tax revenue, not tax rates. The best way to get tax revenue is more GDP. So that's really the best way out. And my closing comment, inflation doesn't matter. Growth matters. Incidentally, growth will give you the solution to the inflation problem, because no economy that's growing healthily with steady government finances ever has inflation. I should have given you a lecture on inflation, on growth, because that's way more important. I'm like the drunk who looks for his car keys where the light is. I know something about inflation. I don't know a lot about growth. Growth is the most important thing there is. The top is US per capita GDP from 1950 to now. 1950, $15,000 in real term, now $60,000. Any pundit or politician who tells you we need to go back to the wonderful economy of the 1950s needs to remember in the 1950s the average American made $15,000 and now makes $60,000. It's just off the charts. This is a better economy than the 1960s was. The problem of the American economy is that our growth rate used to be 4% and is now down to 2%. If we could bring that back up a percentage point, all of these problems vanish. This is around the world. There's the US, our GDP per capita. We're still doing pretty good, but notice we've way fallen off the trend that we had in the post-war period. A lot of other places are, South Korea is doing fine, but it's catching up. Again, growth versus levels. China, the great worry about China. Well, China grew great, but levels matter, and it's still very poor compared to the US. And look at poor Italy. Look at poor Argentina. Growth does not have to happen. Growth is hard work every step of the way. So growth, once you see this chart, nothing else. Bob Lucas once says, once you see growth, nothing else, not even inflation, occupies your thoughts. The US needs to get back up to the trend. Other countries need to catch up to the US. And when you talk about other problems that they face, climate change. Climate change is a problem, but it's often advertised as, we need, in 100 years, we'll lose 4 to 5 percentage points of GDP growth. 4 to 5, India's problem, make it 5% better or worse, you go like that. If the question is human well-being, India needs to catch up with the US, and this is like 5 orders of magnitude more important. Not to say climate change isn't a problem, it's just growth is the big question of all. So the solution is growth. Unfortunately, politically, that's not really where we are. The inflation has had enormous lessons, and one lesson is that the entire consensus of the 2010s is wrong. So the policy consensus in the 2010s is we have inadequate demand. There's a savings glut, secular stagnation, reserve currency, infinite amounts demand for debt. All you need to do is print or borrow and spend, and the economy will grow. We did exactly what they asked us to do, and we got inflation. So that proves all of that stuff, into the dustbin of history. We are on a supply-limited economy. You want growth, you got to increase the supply side of the economy. Sadly, the 2020s consensus is not strong growth-oriented policy. It's industrial policy, tariffs, protection, ineffective subsidies. I don't mind that they're green, I mind that they're ineffective, degrowth and so forth. Now, that would seem very depressing, except I want to close with a optimistic note. Economics is the little Pandora in the box after all the other devils have escaped. And we know something none of them are paying attention to. We know about incentives. Politics is all about I take from you, I give to you. It's a zero-sum game. It's about transfers. It's about protections. Nobody in politics is paying any attention to incentives. So if you think in terms of incentives, there's all sorts of free lunches out there that if we can get anyone to pay the slightest attention to us, can really invigorate growth. So that's the end of what I got to say, and I think I have time to take some questions. Jim, Uh-oh, I'm in trouble now.
Well, I'll start with the standard question, which is what about Japan? Debt to GDP much higher than the U.S. They didn't seem to get any inflation ever in the last 25 years, 30 years.
I should have brought my Japan slides. Now, is Japan's debt sustainable? What about Japan? High debt to GDP ratio. And why? Now, of course, why don't we have inflation already? Debt sustainability is not a unique problem for fiscal theory. The new Keynesian model also has the same valuation equation. It's just achieved by some mysterious lump sum taxes. If the valuation equation fails, every other theory also fails. So it doesn't really distinguish monetarism, new Keynesianism, or fiscal theory. They all say the debt gets paid off. The value of government debt is the present value of surpluses. We just disagree a little bit on what mechanism makes that happen. If that's not true, we're all in trouble. So number one, it isn't really particular to one theory or another. You look at Japan, also, it's not as bad as it looks. Japan has a big debt to GDP ratio, but they also have a lot of assets. And their debt is long-term debt held by old Japanese people who face an estate tax, not short-term debt held by foreign central banks and Americans who tend to go out on a round-the-world tour when they're old rather than sit on debt. And Japan, for the moment, has very low interest rates. So something I haven't emphasized, the present value part matters as much as the surpluses part. And one thing we've learned in asset pricing is that the discount rate, the rate of return, matters enormously to present values. So as long as Japan is able to borrow it at 0.5% interest rates, it's always the cash flow that gets you. And so where the crisis comes is when the interest rates go up and then you find you're not able to service the debt. So far they've gotten away with it. And I think the same is true for the US. At low interest rates, we're sustainable. At high interest rates, we're not. So Japan is vulnerable, but it's not, that doesn't push it automatically into the crisis territory. For some reason, people think Japan can pay it back. And as long as the interest rates are that low, it can pay it back. That's the short version. There's a longer version, but I don't want to start another hour lecture about Japan. Please, someone else. Yes, in back.
So you touched on this briefly at the end. So it's been many years since the classical theory of political business cycles and like the Rogov-Seeger paper. How do you think the impact of political landscape nowadays is affecting policy?
Oh boy. So really, what I have to say is something about inflation and not where do business cycles come from. And what attracted me to macroeconomics versus micro. Micro, it seemed to me like we knew all the answers, supply and demand. Macro and finance, there's great puzzles. Why do stock prices vary so much? Why do exchange rates vary so much? Where the heck do recessions come from? And nobody really knows. So part of recessions is certainly a political thing. Part of it is a financial thing. Part of it is monetary contraction. But that's kind of separate from the question of where does inflation come from. And so I'm trying to think about inflation in a way that holds for all different kinds of theories about why is there ups and downs to the economy. And supply shocks. We have finally seen, so the last couple of recessions, we used to think recessions were due to the Fed. The last couple, well, I'm sorry, let me back up. Milton Friedman really had this view that all recessions were due to the money supply, and Rogoff was, well, here's something else, political business cycles or real business cycles and so forth. One thing we've really learned, and that I think has become true of the world, is that recessions are much less of a monetary phenomenon. 2008, what caused that recession? It was not the Fed clamping down on the money supply and not having enough money to make transactions. There was a financial crisis. COVID was a supply recession, not a demand recession. We didn't have a recession because people didn't have any money. We had a recession because the stores are closed. It's like a snowstorm recession. So that didn't have anything to do with the Fed either. So we really are coming to, I think monetary policy kind of affects things on the edges, but thanks, I think, to good policy by the Fed, recessions have not been centrally a monetary fact. So they might be a political fact, a real business cycle fact, a financial fact, something else. They do clearly affect the path of inflation, but this is kind of a separate thing. Where does inflation come from in the long run? So that's all by a long way of saying, interesting question, but kind of orthogonal to what I have to say.
You said it's all about growth, right? And considering that a lot of that growth over the last several decades have come through a very interconnected world, and that right now, geopolitically, we're probably as divided as towards the end of World War II or the Cold War, depending on the interpretation. What are your perspectives of growth moving forward?
Yeah, carving up the world and doing things very inefficiently at home that foreigners could do for us cheaper is bad for growth. Now there's always national security is an important issue, but I think way too much gets wrapped in the flag. So that's a big danger for economic growth. As you know, the 1930s Smoot-Hawley tariff is what everybody hauls up as a great example of how trying to do inefficiently at home what foreigners can do better for you is bad for the overall economy.
Do you think non-monetized deficits increase real interest rates and then influence growth?
Yeah, that's a tough question. So let me try to translate the question for everybody else. There's this crowding out theory that says that when the government borrows money, and it borrows real sources, non-monetized deficits, it borrows real resources, that takes money out, that is money, that's savings that can't go, therefore, into somebody else's investment. And so as a matter of budget identity, that has to be true, unless, of course, the savings rate, if people are willing to consume less, save more and give that extra savings to the government, they can still give the same amount of savings to private businesses. So that seems awfully true, but I know at the empirical literature it's awfully hard to see large deficits causing interest rates to go up. And I think part of that difficulty, this is always the problem in economics, it's always supply and demand. Why have deficits exploded so much? Why did our governments, so here it is, surplus, and we're almost in surplus late 1990s, and then the deficits got enormous. What's going on with these huge deficits? Well, I think part of that is a reaction to lower interest rates. The savings glut, whatever it is, happens, interest rates go down, and our government was faced with negative real rates of return. Of course they went on a spending spree. What does the average Joe and Jane do if the bank says, hey, we'll lend you money at minus 2%? We'll borrow a lot of money. So I think some of the crowding out is hidden in the shock that gave governments lower interest rates, and then they borrowed along with everybody else. So the bottom line is it's hard to see that, in part because we're in a global capital market, and all these other things are going on at the same time. We're done, I think. Thank you so much. It's a great pleasure.